In this lesson, we're going to talk now finally about how transactions are actually recorded. So far, we've done a whole bunch of not real accounting techniques to just as learning techniques to get you to start to understand debits and credits and accumulating value in accounts. So what we're going to do now is actually start to learn how to record them, how accountants actually record transactions with debits and credits. And that's done in the general journal. So what you need, if you want to follow along, you need a Flash webpage version of this. Otherwise, just watch the video. And here we go. So the general journal it's called a journal because it's very much like a diary. It's where you record all of your transactions. And if I haven't said it yet, I'm pretty sure I have. The people that normally do this are not actually accountants. Accountants will supervise the activity, but this is often done by sort of entry-level accountants or bookkeepers. But people with CPAs or designations often will use the end results, so the financial statements or internal management accounting reports, to make decisions. In fact, you'll find, if you look into the career path, that most accountants don't even work in accounting. They're often CEOs and other things because, of course, they have that in-depth understanding of the language of business, of accounting, right? So let's start. So this is sort of the accounting cycle that we know so far. Up till this very moment, we posted directly with our debits and credits into T accounts, then used the balance in those accounts to make our trial balance. And then we used that to make what financial statements we knew how to make, which was balance sheet, and soon will be income statement. We're now going to learn how to properly journalize. If you hadn't noticed, it's rather tedious to go directly with transactions into T accounts with your debits and credits. It's a little bit easier to actually journalize it or record it in a transaction. Again, you can follow along yourself and read this. I'm not going to read it out loud. But what we want to focus on are a couple of gaps which you may know already, and that's the objectivity gap that you can't, and the cost gap, that when you do record these transactions, you are recording them at the cost to the business at the time, the historical cost. And you need evidence for that, which is usually some sort of document, like a receipt, or a memo even, or an invoice or a bill. Otherwise, you don't have objective, reliable evidence, right? It goes back to that purpose of accounting, to produce reliable information for decision making. Not reliable, but useful information, and useful breaks down into a bunch of things, one of which is reliable. This evidence in general terms is just called source documents, all these bills and invoices and stuff, right? So let's see how we journalize. So in the olden days, it looked like this, and you had a whole bunch of extra lines because when you did it by hand, these were the cents columns, the ones, the tens, the hundreds, and thousands and beyond went in that column. But essentially, in a computer, that's not relevant, but that's what they're all there for, those extra lines. So you do have a debit and credit column. You've got a space for the title, for the name of the company, and the title general journal. And you've got a running date down the side. There's no there's no date up here because the date runs down here for each transaction. The particulars are where you put the accounts affected and any description of the transaction. Generally in school, you don't write descriptions because it just takes up a lot of time and space. Here's how this works. If you recall, we've looked at these transactions before. We're going to do them again. So when we just did debits and credits into T accounts, these were the same ones. We're going to do them again. Quick review of the steps. Is it a transaction? If so, what accounts go up or down? And then think, what makes them go up or down? And you got to remember those rules, right? The whole, if it's on the left side, it's a left entry to make it go up, and the opposite to make it go down, et cetera, et cetera, et cetera. So let's do the first one. So the owner begins a consulting business by investing $10,000. And just as previously, we decided we were going to have more cash and we're going to have more equity in the business. So we enter the date, and this was the first. So we'll just say it's the January 1st because I didn't put it a month. So on the first, we have more cash. Cash is on the left side of the equation. It's an asset. So a debit entry is going to make cash go up. So we debit cash $10,000. Notice the debits come first in the journal. So if you have more than one debit, you got to list them all first before you list a credit. This, you're going to use account numbers here eventually, but for right now, we're not going to fill it in until I show you what some of your practice exercises look like. And the only thing we're going to do there is probably put a check mark or something. And what that is for is to show you that you have in fact posted this line into the T account. so that you don't forget what you've done and what you haven't done. So then we would debit $10,000 and we would do the credit. Now, in the olden days, you were supposed to indent. It was for your eyeballs, basically, so you could quickly spot all the credits. That is no longer relevant because it's done in a computer most of the time, so don't worry about it. Most of our exercises don't even let you indent. Don't worry about it. You don't need to repeat the date until the next transaction. And in fact, this example, I don't think you even need to repeat the month. But most of your exercises will have you repeat the month. Then you credit equity or capital, whatever the name of the account is, $10,000. And likewise, you just keep going. You can put descriptions if you're told to. Otherwise, there's an example of description. It would describe the transaction so you knew what this entry was for. Then you leave a single space. Then you enter the second transaction. Owner purchases office equipment for $3,000. So you have more equipment. That's an asset. That's left side. So you would take office equipment and debit at $3,000. You bought it with cash. Cash is on the left. So it's going down. So you credit cash $3,000. And so on and so on. So on the third, you perform services. That's a type of revenue. So you would debit cash $5,000 because that's an asset and you got more of it. And you would credit your equity, or in this case, it's a type of revenue account that we'll get into in the next lesson, $5,000. So this is like equity. So we credit it because we have more equity, and equity is increased by a credit, and so on and so on and so on. That's journalizing. You can go through the rest of this if you like, but that's essentially it. It's that simple. Before I finish the lesson, though, I want to show you what the first practice exercise looks like. I want to run through a couple of things that you might have trouble figuring out unless you're told ahead of time. So here we are on our syllabus. Our first exercise to practice journal entries after lesson 5 is exercise 12. So we're going to click it, open it, make your own copy, and I'm going to skip right to that point. So here we go. Moving from left to right through the accounting cycle, we have these steps. So we're going to start with our opening balances. As you can see, we have some, and an annoying teacher trick of making you have to figure out what cash is based on the equation is also in this one too. So once you've figured it out, here's what you need to do. You would have to go and set up those balances here in your account. So let's do that. So here we are. There's a slight difference on this page compared to the other ones you've seen so far. You see here, there's a reference to the journal. The journal's on a different page tab, but here you have it flowing in from that page as you do it so that it's easier to post for you into these accounts. So we've set up our accounts and our opening balances. So now I'm going to go back to the journal, right? Because these starting balances are in. Our next step is to journalize our transactions. So I'm going to do the first one for you. And the first one takes place on October the 1st. And our particulars are the accounts that are affected. So we received $1,000 due from a client since last month. So clearly we received cash, right? Because we got paid money. So, and it was $1,000. So we debit $1,000. And that means the person doesn't owe us as much anymore. So we credit accounts receivable for $1,000 because they paid us, so they owe us less. This makes cash go up. This makes accounts receivable go down. Both are assets, so that balances the equation. This posting reference, you don't go to post until the second step of the accounting cycle. You finish all your transactions first, but I'm going to do it because this is just a quick overview of the activity. So when you are done and you're at the next stage, you can see that the journal entries have carried forward onto this page just to make it easier for you to do the activities. So here in the beige, you'll notice it's free for you to do stuff. If you try to do something here, it's going to tell you, whoa, don't do this, you'll screw up your spreadsheet, right? But here you can. So posting is easy to screw up when you have lots of transactions unless you follow the steps very methodically. The good news is we don't do posting for much longer. We let the computer do it, and we focus on our journal entries and our financial statements. So here's how you would go through all your transactions from the top to the bottom. Do not just go through all the cash ones and then go through all the accounts receivable ones. That's how you make mistakes. Go through each line by line. First thing you do, October the 1st. Okay, you know what? I'm going to do two. Let's go back to the second one. Leave a space, always one space. October 2nd. Purchase $25 of office supplies for cash. So we will go, we don't have office supplies. It must just be supplies. And then we're going to credit cash. And that's going to be for $25. Done. All right. So now let's do this. So here's our two transactions. Cash is $1,000. So we go to the cash account, we put in the date. That's the first thing we do, October the 1st. Then we put in debit, $1,000. That line is done. Put in the check mark. Post it. You'll notice back in the journal, the check mark automatically appears to tell you in the journal you've posted that line. Then you move on. Next, accounts receivable. You go to accounts receivable. First thing you do, you put in the date of the transaction. You put in the credit, $1,000. Before you do anything else, you go back. You put in the posting reference, which is not really a reference yet. Eventually it'll be an account number, but you put in the check mark to show you're done. Next line, supplies. We go to supplies. We put in the date, October 2nd. We put in the debit, $25. We go back. Check, done. Next, cash, back to cash, October 2nd. Credit for $25, check. That's how you post. So you now have actual accounting for the first 3 steps of the accounting cycle. Journalizing, posting, and then of course once you're done all this posting, you come up with balances for them for each account and you make your trial balance and then proceed.